Hello and welcome to the ASB Investment Podcast, the show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that will be happy to chat if you need. Well, hi everyone and welcome to another episode of the ASB Investment Podcast. I'm your host as always, the man with two first names and a severely jet-lagged host at that. I'm Nigel Grant, it's great to be back. And a special note, this is our 100th episode of the show. To all the listeners and their hundreds of thousands of hours listening to some of the most potentially boring topics you can get out there, but this is what we do with it that makes the show. It's wonderful, and we just want to acknowledge everyone that's joined us on this wonderful adventure. And so what better way to celebrate this than to bring back one of our most frequent guests so we can nerd out together on all things affecting your savings and investments. We're joined again by a familiar voice, our resident senior economist and friend of the show. It's Chris Tennent-Brown. Chris, how are you?
Not too bad, thanks. I'm probably feeling a bit perkier than you.
You are. You're on fire today.
I didn't have a the big long plane flight to make me jet lagged. I just had a little short one. And
what little short one?
I went flying around by myself in the last couple of weeks while you've been away. But half an hour here, half an hour there. And the Chipmunk.
Oh, a Chipmunk. What was the name of the plane that I told you I was in while in Australia?
It looked like a Piper. Yeah, like a 6-seater Piper, wasn't it?
It was 6 seats, yeah.
Yep.
One of those 6 seats was used by a participant who had motion sickness. Do you want to guess who that was?
Did they have two first names?
They did, yeah, and they hosted a podcast, yeah. So it was...
I never thought you'd be a white knuckler, but...
No, and this flight was a mere 15 minutes, then that was elongated to 30 for sightseeing on the way to Rottnest Island out in Perth, which was a wonderful trip, I might add, but I'm just not cut out for... much motion, I'm cut out for the motion of markets, but not for just small trips.
Oh, right. So did it spoil the Rottnest visit, or did the quokkas perk you up once you saw them?
We got to see whales on the ride on the flight to Rottnest, that they were out just in between, I think it's like 19k from the mainland to the island, but the quokkas were beautiful and very cute.
Good.
Yeah, for those that don't know what a quokka is, it's kind of like a cross between a koala and a rat.
Yeah, that's probably a good way of describing it. You can Google them.
Yeah, and I think Roger Federer had a photo with a quokka when he was in Australia, and that's how everyone got to know them.
Yeah, well, there you go.
They're very friendly. So I enjoyed meeting the quokkas, and I shout out to my wonderful friends who hosted us while we were in Perth for our holiday. Apart from flying around, any other thing you've been up to that's been interesting?
Well, I had to do my lonely podcast while you were away by myself, so it's good to have some company, yeah.
Did you do a podcast while I wasn't here?
Yeah.
Was that with you?
Just me.
Was it?
Yeah.
I just didn't even know.
Oh, you'll have to get yourself back up to speed.
Oh, gosh, I'm really suffering the jet lag effects. And how was it being in the hot seat?
I felt like I was like a sports star. I asked questions and then answered them in the third person.
Oh, well, gosh, this has been quite the surprise to me. To set the scene for this episode, we're going to be exploring OCR decisions and mortgage rates and how ASB is helping customers, sort of understand what's going on there. If we get straight into it, we are, at time of recording, literally about 88 minutes from when the Reserve Bank made its decision today on Wednesday. To put it simply, CTB, what happened?
Well, they made their decision. Luckily, it was what the economics team thought they were going to do, so I could leap in the car and then drive here to this podcast.
Yes.
That's what happened. To unpack the meeting itself, we thought the decision was always going to be, do they cut by 0.25% or 0.5%?
Right.
We went for 0.5%. We were reasonably concerned about how much the economy has slowed and how soft the recent data has been.
And there's off the back of that big GDP report especially.
Yeah, that I think got everyone's attention.
Yeah.
Forward-looking indicators like NZIER's quarterly survey of business opinion last quarter and the one that came out this week were pointing to signs of weakness. Other leading indicators were as well. So, and of course, we've talked about the housing market being very flat and not responding so far to lower interest rates. So all of these things were in the mix that we thought the economy needs a decent shot in the arm, and GDP was really the one that got us across the line on the 50 basis points or 0.5% cut.
Which is what they've done.
Okay. Yep. And they've signalled that there's potential for more to come. They're open to...
More cuts to come.
More cuts. After that weak economic data, we thought, okay, rather than stopping at around somewhere between 2.75 and 3.25. They're going to need to get it down closer to 2. So we're forecasting another cut at November.
And because there's November, and then there's the summer break, and the
Yeah.
next one after that is in February, right?
Yeah, so
they've got only one more chance before the end of the calendar.
Yep, and really it's a nearly 3-month gap in between. So, we've got 6 weeks until November. We think they'll go again and then get back to the usual thing of watch, worry and wait.
Right, okay.
And of course, after the November meeting, we get a new Reserve Bank governor.
Yes, we
who's
do.
been appointed while you've been away.
And well, I follow everything. I saw the announcements, but you came across there as if, am I correct? Are you thinking it might be 50 again?
No, I think it's more likely to be 25.
Right, so down to about 2.25
Yep.
and hold there.
Yep, and then reassess next year.
And so why, for those who aren't as familiar with it, why does this OCR thing, the official cash rate, matter so much?
For a start, it's the basic lever that the Reserve Bank's got to pull to do one of its key jobs, which is maintain price stability within the economy, which in basic terms means keeping consumer price inflation around 2%. So an interesting thing is now it's closer to 3% at the moment, but they're still cutting.
Well, so why?
So what the Reserve Bank is effectively doing is looking at the outlook for inflation as well as where it is right now. So when you get the mix of economic conditions we've got now, where the economy's softer than we'd like, softer than what we thought it would be, and similar for the Reserve Bank, you in turn will be thinking it's got more capacity, it's going to generate less inflation pressure over the coming 6 months, 12 months, given the soft patch it's in. And particularly when we look at forward-looking indicators like employment intentions, which are weak at the moment, firms' ability to put up their prices. Not great when you're seeing such a soft retail environment.
So they're prioritising that side versus hell-bent on inflation down to the midpoint of 1 to 3.
It'll get down there. That's the view, is it's going to get down there. The economy's got enough capacity in it. So the more important task becomes supporting the economy by getting interest rates lower. Now, remember, 6 months ago when we were talking about this, we were thinking, okay, well, inflation pressures are very high and looking very sticky. The Reserve Bank's going to be prioritising that. Now, the priority shifts to worrying about the growth outlook. They don't want the economy to be too weak and get into the opposite side of the problem, that the downturn drags out for longer.
So thinking of mortgage rates and how does the OCR impact what people pay? And I know it's not just about mortgages. We'll get to sort of the other side of the balance sheet as such, but it can impact and does impact what people pay on their home loans. So I guess a question we always get asked is, why don't those rates always flow through exactly where the change at the moment it's decided, or flow through basis point for basis point through to rates?
Yeah, that's a good question. And I think to start off with, it's good to clarify what are we talking about with the OCR. The OCR is the official cash rate.
Yeah.
So it's an overnight interest rate. It's not one that retail customers or businesses will be using. It sets the rate that banks will do overnight transactions with each other, and it sets it's the reference rate, if you like,
risk-free rate
for what we would borrow or deposit money with the Reserve Bank overnight. That's all it is. It's not where we fund mortgages, but it's heavily influential on wholesale rates, particularly the shorter terms.
Mm-hmm. Which can be local and overseas.
Yep. And via that mechanism, it flows through to other rates. So I think it's an unfortunate sort of use of words to go passing through the official cash rate cut, because there's nothing to pass through effectively.
Sure. Yeah.
What we do is we fund ourselves. Those are our liabilities as far as the bank's concerned. Mm-hmm. The term deposits, the wholesale bonds that we issue, corporate deposits.
Because they have to be paid back at some point.
We have to pay them back at some point, and we have to pay interest on them. On the other side of the balance sheet are the mortgages and business loans.
The assets.
And then that's right. And then things like the official cash rate influence the rates that we can hedge at, but they don't actually influence those big buckets of funding and books of loans. They don't directly influence it. Where they do have a big influence is on the very, very short-term rates.
Yep.
And so a floating mortgage you'll tend to see move quite quickly with the official cash rate. but not always blow for blow. Just like on the way up, when rates were getting tightened all the way from 0.25% to 5.5%, and on the way down,
a 0.25%.
It hasn't been lockstep moves each time. But there's such a big focus on the RBNZ data go what's happening. And so we tend to see a lot of activity, a lot of interest in mortgage rates. But for example, in ASB's case and several other banks, we adjusted some of our fixed terms last week.
Yeah, based on what was happening in other markets.
Based on the fact that markets were pricing in, to a large extent, what happened today. We've been saying 50 basis points. A lot of other economists were saying the same. Markets were sort of priced in the middle. Some were thinking it's going to be 50 basis points. Some were thinking it's only going to be 25 basis points.
Okay.
But if we look at something like a 2-year wholesale rate, it effectively was pricing that the official cash rate's going to get down to close to 2%, which is what we've been forecasting. So that's why we've got the ability to move something like a 1-year or an 18-month mortgage before the decision itself.
And sometimes need to.
Yep. And sometimes need to.
And so in the statement today that the Reserve Bank puts out, was there anything that stood out to you as kind of key messages or surprising, if there was anything, for borrowers, do you think, looking forward?
No, I think what's surprising is if you go back and look at how we were feeling and how some of the Reserve Bank's comments were 6 months ago, we're clearly in a different situation than what we imagined back then. I mean, the Reserve Bank, if to use the sort of jargon we use, is quite dovish when they're saying, hey, we've cut and we're open to more cuts, particularly when we're pretty close to the end of this easing cycle. It's unusual to...
Well, we've had conversations that it's probably as low as it's going to go.
Yeah, that's right. And so the classic economist saying is, when the facts change, I change my mind.
That's right.
And the facts have changed. The economy is softer than what we thought it was going to be. It's not spooling up like we'd expect with low interest rates. And in fact, when we wrote up our... report on business confidence, we essentially said the business's wheels are spinning in the mud at the moment, sort of just not going anywhere and gaining traction with some of the things that we'd thought should be a bit more supportive than what they are.
So no surprises as such, apart from potentially just compared to maybe 6 months ago in our conversations, just that how things have turned out. That would be
Yeah, and so, I mean, the Reserve Bank, they've done what we've thought that they should do, and they're obviously seeing and interpreting the data flow the way that we are. And the silver lining, I guess, from a disappointing patch for the economy is that it's leading to mortgage rates being lower than what I expected.
Yeah.
So borrowers will be able to get rates that are 0.25%, 0.5% lower than what I was forecasting when I thought the official cash rate would have finished getting lowered by now.
And so in terms of what this means to flowing on to customers and their approach. Now, obviously, we don't give advice here, but you and I have had conversations based on the information we knew, the facts at hand at the time, and what we thought, or what you thought were important for customers. For a customer who has debt, has anything happened today that you think changes what you and I have been talking about for ad nauseum?
I think that the main thing I reflect on times like now is that the future is unpredictable, and as an
case in point,
and as an investor or a borrower, you need to have a strategy that can deal with that, whether the unpredictability is favourable or not. For example, imagine if the economy was really taking off right now and people sitting around thinking, oh, the cash rate's going to get a little bit lower and so will mortgage rates, and then we discover the economy is going really, really well. That's something that could have happened.
Yes, and ideally something that the Reserve Bank wants.
Yeah, that's right.
Because of what they did.
Yeah, the balancing that desire to get a low rate with the need to have some flexibility in your strategy and your ability to deal with a changing environment is really important.
And so do you think, I mean, it's a curly question to help to navigate, but in the past we've had conversations, almost like get on with it. These are probably as low as they're going to go. And now they've gone, or potentially are going, at least the OCR is, things are going lower. Were we wrong?
No, I think the way I look at it is this is why we talk about strategies like not having massively concentrated interest rate risk at one point in time.
Yep.
So, for example, if someone had, at the start of this year, thought, I'm going to fix for 6 months, 12 months and 18 months and had 3 terms, well, that 6-month mortgage will be maturing now. So they'll be able to roll into this rate. If rates start going up quicker than what we expect over 2026, then you'll have another mortgage maturing that you could maybe want to push out for a little bit longer.
Yeah.
That sort of thing. Whereas if you just thought, I'm going to hang around and try and get the bottom of the mortgage rate cycle, and you're paying floating rates all through this year, well, it actually still needs to fall a bit further to cover the cost of a strategy like that.
Yeah, what you've missed out on by taking that chance.
Yeah, so that getting on with it is really getting on with a good strategy is always been my message. But that's a strategy that can deal with the fact that you don't want all your interest rate risk coming up at one point in time.
I think we talked about on another conversation, like a single wave. At a beach, you don't want to be, just constant things you have to deal with rather than one tidal wave.
That's it. Yeah, that's the sort of thinking. But to not avoid the actual question, we're always wrong when we have to change our OCR call. So, we were wrong to think that the economy would be going a bit better by now.
Yeah.
It's turned out that hasn't been the case. And therefore, our official cash rate view has needed to be adjusted to what we've got now.
And I guess,
that's our job, and that's why it's so interesting. But gee, you wouldn't last long if you beat yourself up every time you got it wrong.
Yeah,
because things do change.
And if you, I guess to that point, wrong is harsh. Sort of the facts change, so things have changed, and our view has to change with it. I guess that coincides with if you're sitting there, to your point, thinking you can pick, where things were going. Did you pick this? And probably not. Like things going lower. That's it. So on the converse side of it, or the inverse side of it, sorry, what makes you think you can pick it? You'll be ahead of things before it starts going back up.
I think the main thing is hopefully if you can hang around in the job as long as some of the members of the team have been, it's because you usually are either getting it right or you're adapting to new circumstances. It's not unique to cash rate forecasting. Like we did a podcast a month or so ago about investor confidence. Investors are a bit perplexed about why the housing market's so flat. Most property investors would have thought that over 2% of interest rate cuts coming through into the mortgage market, you would have expected to see a little bit more life in the property market. That's not happening, and investors are confused by that. But still, what does that mean you need to do? Well, you just need to adapt to the environment that we've got rather than completely change strategy.
Play the hand you dealt.
Yeah.
We talked about it earlier. The interesting side, the bank has two different sides of its balance sheet, and I guess every customer potentially has two different sides. Hopefully everyone's in a position where they've got some savings, and if they're lucky enough to have a house, they'll be juggling both sides. Lending versus deposits, it's a balancing act, but is there anything that you think, regardless of what was happening today with the announcement, is ageless and people should keep in mind? Or has something happened today, if you've got both sides you need to do, is it still just basically the same advice or information we've been saying?
Yeah, I think there's some maxims that apply regardless of of where we're at in an interest rate cycle. Some basics like always making sure you've got a bit of a safety net for your cash flows. Now that could be a combination of a short-term deposit as well as to complement your mortgage. So if a hot water cylinder blows up, you've got your rainy day fund there to help with it. It could be things like having your mortgage structured so you've got some flexibility via a revolving credit sort of facility. And then the other part of it is having your fixed terms, which are lower than those floating terms or variable terms in terms of the rate that they charge, having those structured so you don't have this big interest rate event every 2 or 3 years. It's just part of your regular decision making that I've got another term maturing. If life's going really well, you might use that as a chance to pay a little bit more off.
Yes.
If you're worried about interest rates rising, which will be the conversation we have at some stage next year, you can reduce that risk by fixing for longer terms.
So just like in a portfolio, it's diversifying your rates.
It's spreading your risk. Yeah.
And the same in your mind applies to TDs or things on our liabilities side.
That's
the
right.
customer's credit side. The same, because we always talk like fixed terms. We talk about generally mortgages. But it's the same that applies there, just staggering out your terms for...
Oh, absolutely. And the trick in the term deposit space for someone that's really focused on that as an investment is we'll typically pay higher rates for the longer terms, which is the case now. But people often don't want to fix for those longer terms. So you can use that same laddering structure. So you've always got a term deposit maturing, but maybe you've got a 3-month, a 6-month, a 12-month, a 24 months. So you can start to tap into those higher rates. Yeah, making a strategy that gives you, for the same reasons, flexibility, what you need in terms of cash flow management is really important on the term deposit side, particularly if it means you can tap into some higher rates, which are typically out at the longer term, but sometimes there's some really nice shorter term attractive rates in the shorter terms.
So we've talked primarily about term deposit savings, interest rates, and then on the other side what mortgages are doing. But at ASB, I guess we've got a broader offering in terms of those things and things like investment funds and KiwiSaver. Again, centering it on today's announcement, what it means for customers is that should, again, not advice, but should investors or savers be thinking broader than just these two main things we've been talking about? With what's happening, does it have implications for investment products and things as well?
Oh, I think it definitely has implications. But one of the things that I've seen in the past when the term deposit rates start getting lower is people understandably say, this isn't working for me, which then leads to the conversation, well, what might work? Where might be a better place for your money?
If you haven't used them before necessarily.
Another reaction today to the official cash rate getting cut is we've seen the share market lift. And in New Zealand's case, we've got a lot of stocks, think utilities, that pay a pretty attractive dividend yield. And in these lower for longer interest rate periods that we've had in the past, that's one area people will look at. Should I be doing something like holding some high yield shares? And for someone that's got a 10-year plus time horizon, that's a realistic approach to get a higher yield. It's a riskier thing than a term deposit, but it should pay you a higher yield over the longer term. And those stocks are responding now, partly because of investor interest in that yield that they
provide that paycheck, right?
And the other thing is we'd see people, if we were paying, say, 6% on a term deposit and people think, this should be around for quite a few years.
It wasn't.
Then it wasn't. But they may be inclined to go, I don't really need to do anything. 6% will get me there. Here we are 2 years later and we're talking about rates that are half of where they were and potentially going lower. So
and I know John always talked to us, about, thinking about how you provide your retirement paycheck that you used to get every fortnight or monthly, and what you're doing to provide that now if you're not drawing the old salary income as such. So I guess that's probably one of the things that populates. I know it's not necessarily all people over 65, but those things do become more attractive. But it's still not about putting all your eggs in one basket, though, is it?
Yeah, exactly. And I think that one of the things that is important to remember is that if you go and talk to someone like an advisor at ASB or a specialist or hopefully an advisor anywhere, it's not like they're going to say, stop doing everything you've been doing and start doing this completely different thing. You might just do a little bit more of one thing and a little bit less of something else. Or you could just have a fine-tuning on your existing strategy to try and make sure it's maximising the returns.
If you don't eat spicy food, you don't go as your first one, then start eating the 3 chili one, right?
Yep, that's it.
I guess the final section now, talking about investment themes, how can people manage their money smartly when both, I guess, TD and mortgage rates are moving around so much as they are? Is there anything we haven't covered off that you'd kind of leave customers with?
Reading is really important,
or listening.
Listening in this case. I mean, for people that are really interest rate focused, there's some good New Zealand websites. People like ASB will have supporting commentary around markets. When I finish recording this podcast, I'll go and update our home loan report and term deposit reports. Get those on the website by the weekend for people that have got nothing better to do than what do you mean? Read a report. I mean, I know you will.
Yes, that's right.
You'll want to read it. But those things are there to try and help people to get this information. And, of course, so are frontline staff to help people with these sorts of questions.
I guess it's, at the same time, though, you'd probably be an advocate for, as much as talking to other people, advice from places like ASB or reading reports or anything you can get your hands on. At the same time, I always go back to what you'd said in a previous edition of the show, which was kind of like make a decision to move almost like, and then get to your hobbies.
I think so. And one of the things which is challenging, I think, for Kiwis, when there's a lot of uncertainty in general, it's easy to sit on the sidelines and do nothing. And I
We're
think
passive, aren't we?
Yeah. We get it every year on the run into the election. I might just wait and see what happens in the election. And I always answer, wait and see what? What are you looking for that you're going to wait and see for? Whereas if you're thinking about buying a house, you should be out researching the housing market now. If you're about to take on debt that might take you 20 years to pay off, this is just one of many decisions you're going to have to make in your interest rate life cycle. So read, listen, learn to know what am I in store for. And one of the conversations that our economic research feeds into is things like, what rate does ASB want to stress test people at? What
am I getting tested at?
How bad could mortgages get? Because we certainly don't want people to borrow money thinking that they're going to pay 4% forever.
No.
And so understanding all of those things and what an entire period of borrowing is going to look like is really, really important. And likewise, on the investment side of things, times like now that are uncertain, I think are great times to just check your strategies fit for purpose.
And I guess we could talk for hours on this stuff, as everyone knows. We'd always have to limit it to about 25, 30 minutes. But to wrap up today's chat on the OCR mortgage strategies, investment themes, I want you to do, instead of me rabbit on point by point, I'm going to get you to stress test each of my points as I go, and if you think it's an accurate summary of kind of what we've talked about. So the first one, obviously, the RBNZ cut 50 basis points. That matched the house view, which is what our ASB team said. One more cut maybe to follow is what we think, and they might continue if weak conditions persist.
Yep, I think that sums it up nicely.
Okay, great. All right, one for one. So OCR affects borrowing costs, but mortgage rates don't always change in step with that. There's a number of different things, international funding, wholesale rates, which way the wind's blowing, but that can affect rates. So don't expect a straight throughput to what you might borrow at or save at, but the key thing is to stay informed on what's going on.
Yeah, that's right. And if you're keeping an eye on it, you would have noticed that rates got trimmed last week.
Sure. Okay. Yeah, but outside of an OCR decision.
Outside of an OCR decision, it's not. In fact, there's many adjustments outside the OCR decision. It just tends to be that this is the one every 6 weeks that people get excited about.
Yeah, and we see the 6 o'clock news with markets shifting. 2 more points. With markets shifting, it's important to regularly review your investments, and that involves reading and seeking advice. So that's probably a non-debate point. But the key thing we go back to is kind of diversify all your risk and all your eggs in your basket, right? And that's broader than just the rate decision you have to make today for a TD or a mortgage.
Yeah, and we usually talk about diversification and risk management when we're sort of thinking about things like portfolios of shares and bonds and property and all that sort of stuff. But the same actually applies if you were just in one asset class. How do I reduce those single moments of major interest rate risk and spread them out a little bit so I don't have these massive moments where your position could change so much.
And I guess I want to just add one point. If you're a term deposit user, have a think about what this means for your weekly paycheck or your fortnightly paycheck, whether that's supplementing super, if you're in the fortunate position to have it. But no one is expecting you to go way out in the risk curve with investments, right? So if you don't use investment products, use this moment to have a chat with someone and just see how they could complement a portfolio of TDs or savings, right?
Yeah, and a good outcome is to have a conversation and have a specialist say, actually, you don't need to do anything different. You're going to get to your goals without taking any more risk than what you are taking. In other instances, you might look at a situation where you go, actually, I want to take on a little bit more risk because I'd like my money to be growing faster or preserving capital better or whatever it happens to be that's your goal for that money. It's just about making sure it's in the right place.
And you don't have to do that decision in isolation, so talk to someone. And obviously you can talk to Team at ASB for that. And so to our final question now, one that I ask all of our guests, it's one of my favourite ones and one you've answered so well in the past, CTB. What's something you've been reading, listening to or watching that you could recommend to listeners this week?
Well, I live in Onehunga, that some listeners might know that.
The home of Dressmart.
The home of Dressmart, but it's also the home of the Dolphin Theatre, which is a local theatre.
Okay.
And I went there last night and watched a play called The Atom Room, which is about a couple, one of them who lives on Mars, and the other lives in Wellington, and
quite the polar opposite.
Yeah, that's right. And they run their relationship through this thing called the Atom Room, which is where they imagine the internet will be in 50 years' time.
Okay.
And it was,
so it was a play,
yeah,
theatre.
It was fantastic.
Not a movie theatre, the theatre.
The theatre, yeah. I thought it was fascinating. So anyway, I think they've still got a few more nights to go. Worth a look.
Okay.
So that was my highlight of the week. So that's what I've been watching.
Okay. Well, I had two. I just wanted to do a shout out for Perth. Great city. It was where I went for my holiday to see some wonderful friends, as I said. During that time, amongst the key sites of Perth as well, and going to an All Blacks test, I was also catching up on some reading. So I finished my second book on the Middle East.
Oh, wow.
Recently. And this one was a short history of the Gaza Strip. So I'm just trying to read more about this area with everything going on in it. I just thought it was really important to kind of know a bit more about these conflicts and important to educate oneself. So, and I'm onto a third one now called Jerusalem and the history of that.
Excellent.
Yeah, 500 pages, just light reading.
Yeah, you just have to have a light break and read my home loan report.
Yeah, yeah, correct. Yeah, just come out of that and just,
It's only a 2-pager, so you can fold it in half and use it as a bookmark.
Right, okay. Well, I'll keep that in mind. I'll ask Fran, my daughter, if I can replace her bookmark with your home loan report. Thanks, CTB, again, for giving your precious time, as always. It's a pleasure having you on the show. And you're on here almost every week, so we look forward to having you back. Insert whatever week that is. But until then, happy investing and happy navigating what's going on with rates as we've been talking about. I hope this conversation has helped you navigate everything that's going on. And it's bye for now. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on this episode, or if there's anything you'd like us to discuss on a future show, get in touch with us at podcasts@asb.co.nz.